And good morning once again, options traders. Well, big day in the markets today. We've got the Fed speaking at 2 p.m. Looking forward to that, I think. We'll have to see. It's always an exciting day when the Fed speaks. You just never know what to expect from the market. But I wanted to, in the meantime, post a video here as a response to some comments I've been getting from traders, actually for a long time, but more recently, when I talk about, let's say, a certain position and I'm going to hold it for maybe 2 years, or that's my expectation, they go, oh, wow, that is so long. Why do you go out so far? And they've got this impression that when you're trading options, everything has to be super short term based on what you think is going to happen. And I've talked about it many times before, why day trading rarely pays off. I've showed it in many different forms. But let me give you another perspective that will at least help you to understand why I have a longer term mentality, but that doesn't mean that I'm not really making short term decisions. So let's go find out what that's all about. And before we do, as always, please be sure to click like and subscribe. It definitely helps to promote the channel and is greatly appreciated. So let's start off with a very simple model. And I'm going to assume that a stock starts at 50 and let's just say that it ends at 60. And my view is that the stock is going higher. Of course, we can use options. I'm just using stock to make it a little bit easier. So notice that the stock goes from 50 to 60, and that is a $10 gain. So, of course, I don't know if it's going to be $10, but I just expect there is going to be this long-term upward drift, which is a fact about markets over the long run. So now you might think, well, hey, this is highly unrealistic that the stock goes exactly up $1, let's say, each step. Maybe this is every day, it could be every month, whatever you want to do. But that's really the beauty of math. We can just say it's some kind of an increase over some period of time. So hey, let's make it simple. Let's make it go up $1 a day for 10 days. Now, the day trader over here is going to go in and out based on what he thinks. So take a look at what's happening. If the stock goes from 50 to 51, he buys it at 50, closes it at 51, and in his mind, he's locked in that dollar gain. And then he says, you know what? I think it's going higher again tomorrow. Let me buy back in here at 51, and hey, it went up. Let me close it and lock in that dollar gain. And now I'm up $2. And then same thing. Let me get back in at 52, goes up to 53. Now I've locked in another dollar. And they feel psychologically that they have locked in this money, which is nothing could be further from the truth. It's not locked in. They always say, oh, well, if you take a loss in the future, just kind of match these gains up against those losses. Well, that's the same thing as saying it's a loss. This is not at all locked in. It's a comfort zone. It's a crutch. But the point that I want to show is that if this trader does this every single day and he's right, notice that he makes exactly 10. Exactly what I did just by going from the start to the end. And that will always be true, no matter what numbers we put in between here, that these individual steps, what are called the marginal trades or the marginal values, must add up to these extremes. It absolutely has to. So an analogy I've used before, think of this as an elevator. If you get on the 50th floor and you go to the 60th floor, that's 10 floors. Well, you could get on the 50th floor and go up a floor, go up a floor, go up a floor, and so on, do that 10 times, and yes, you're going to end on the 60th floor as well. You will also be up 10 floors. So that has to be true no matter what these numbers are over here. And we'll look at an example in a moment, but think about this. If I buy the stock at 50 and it climbs to 51, I do have to make a decision. Do I want to stay in it? If for some reason I think it's going to plummet, based on new information that's arriving in the market or something specific about this stock, and I want to exit, I can certainly do so. And I could also, just like the day trader, get back in. But just because I don't exit and get back in doesn't mean I didn't make a decision to stay in. Every day is a new day. It's as if the position is opened every single day. That's really the point of marking to market. Your broker says yesterday the stock was worth 50, today it's worth 51. Doesn't really matter what you paid for it, this is what you have at risk right now. So even though I might have a longer term view, I still have to make daily decisions about whether to stay in it, hedge, roll, morph, or do something. But just because I'm not actually pulling the trigger and exiting the position and getting back into it or into something else doesn't mean that it changes the math. This is where, again, the misperceptions step in. People might buy at 50, sell at 51. They go, I'm going to lock in this dollar gain. Let me move on to a different stock. Well, you're just in exactly the same table on a different ticker. And instead of running from 50 to 60, maybe it's running from 100 to 110, or whatever series of numbers you want to use. It's exactly the same game every single day. Well, now let's expand it a little bit, make it a little more realistic, and let's say that we get a little more volatility now. So now we still have the stock going from 50 to 60. So if I just take the extremes, I buy at 50, I hold it for a period of time. Again, it could be 10 days, it could be 10 years, whatever you want to use. It's the same point. But I pick up 10 points. But notice that I'm not getting in and out on a daily basis. The day trader over here, let's say, gets in and out. So he buys at 50, closes at 49, he's down $1. And of course, he thinks this is good risk management because he's limited the losses. And then he says, okay, I want to get back in. Let's get in at 49. Next day, it's at 48. Bummer, lost another $1, but let me get out. We get in at 48. Ooh, today it went up to 51. Now I collect 3. And then they'll say, oh, I can use these gains to offset these losses. Look at that, I'm up $1, and I've avoided all of this volatility. Buys at 51, gets out at 53, picks up another $2. Gets all the way down here, and on this last day here, buys at 55, closes at 60, and look what happens. He makes exactly 10. It's exactly what we just looked at. It's just a little bit of an illusion when we start putting in the volatility. But again, all of these intermediate steps must add up to the totals. And again, think of it like getting on the elevator on the 50th floor, going down a floor, up 3 floors, up 2 floors. Obviously, you've got to end up here on the 60th. That's the only way that we could go from 50 to 60. All of these marginal values must be the same. But here's the difference. For the day trader, if you're going to get in and out and pick which days you think are going to be best, now that changes things. And out of a series of 10 days, if you're going to pick the 5 best days, that's going to occur 1 out of 252 times, or a probability of 0.0039. Don't expect it to happen. Now your average, if you're just going to go in, let's say 5 of these days, your average will be $5 instead of 10. Because think of it like the elevator. Instead of going from the 50th to the 60th, on average, you were in it only half the time. So you were in it only for half the ride. So on average, you went up 5 floors. And then finally, the chances for you to beat 10, at least based on the numbers that I've put in here, is about 16%. So 84% of the time, you're going to fail. So see, that's why I've always said, if you have this expectation of there being a long-term upward bias, whether it's for an index or a stock, buy it, hold it, hedge it, morph it, but there's no reason to get in and out every single day. Because now you're playing the guessing game of which days are good and which days are bad. And the chances that you beat the buy and hold, at least in this example right here, is about 16%. So the thing to think about is that, yes, if you want to consider yourself a long-term trader, which is what I do generally, in a way you are a short-term trader because you have to make daily decisions. And that shouldn't change it to where you're saying, oh, you're just a long-term trader. You're not like the active guys in here. I am. I have to make daily decisions to do something. But just because I'm not selling it and getting back in or getting back in a day or a week doesn't change anything. I still have to make daily decisions. The reason I just avoid all of those intermediate steps, at least usually, is because I'm just trying to avoid picking which days are the best. If you have a view that there's going to be an upward bias, it's a lot easier to just buy and hold. Then it also adds another insight that if you're going to buy and hold, it makes you dig deeper and think, why am I getting in this position? What are the risks? How should I hedge, roll, and morph before things blow up? And you'll find out that you'll make much better decisions when you understand your option strategies and you take longer-term views. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.